Good evening, guys. Ken at Tortoise Capital, nightly strategy podcast for Saturday night, Saturday night, February 4th, 2023. So we'll start with Chi Wing Chong's review of the 30 period regression line slope, uh, the Z score of key sectors in the market. So the main idea behind this again is that if we take a look at 30 price points and then draw the regression line, that regression line is the best description, the lowest error description of that price. If we then say that is a zero slope line right here, or flat, the angle of the slope, the degrees of angle alpha, tells you how strong that move is. The steeper up that is, the stronger the move. And so each day what we do is we drop off the last one and add a new data point and then recalculate this. So if price did something like this, that line would slowly start rotating. And it turns out that that is a much more adaptive moving average than a simple moving average. It's very precise. So we find that the 30 data points, the slope of that line, now if you go back 180 days and you plot the slope value of each one of those, you get these individual data points. And then what you can do if you go back 180 days, you can find from the zero line, what was the steepest upward it ever got? What was the steepest downward it ever got? And then you'll find that starts to take on a shape of almost a bell curve around the zero line, around the average. And that as it starts getting up here in the upper regions, it's pretty rare and an abnormal condition. So we take the average, instead of just calling that the zero line, we're going to take the actual average of the values of the last 180 days, and then we're going to find the standard deviation of that. And we're going to call everything between +1 and -1 normal. So in this case, every time those lines are contained inside this region, it's a normally behaving market compared to the last 180 days. And so there are periods of time when it breaks north of that, that's an abnormal market condition up here. And when it broke below -1, this was an abnormal condition down here. So what you are not surprised to see is this kind of oscillation between bad markets and good markets and bad markets and starting to be good markets. And now when these slopes begin to get near the +or -1, we start looking for evidence of abnormal behavior continuing, like in this case, XLK has moved into a leadership position while XLE has rejected the boundary of the channel, is starting to decay. So energy weak, tech strong, market strong, and the leadership has rotated away from finance. So finance was in the lead all the way up to here, and now tech takes over, and the market is strong on the back of the big tech sector, but finance and materials are starting to decay, and energy is already into the decay. So now there's a clear front runner that's pulling the market north. Whereas for a long time, that was the lagging sector. So by understanding this kind of a plot where you find the average +or -1 standard deviation, treating that as normal, and then this is abnormal to the upside, and this is abnormal to the downside, you can begin to isolate moments in the market where we can expect different kinds of behaviors. When the market's behaving normally, you get fewer surprises. When it's abnormal, you get larger moves, either continuations or big reversals. So we're going to see that theme with respect to price, to volatility on every time frame, and we can now use that to compare between sectors. Like, this is when it was easy at the turning point, everything's going up together. That's evidence of big money buying the market and equally distributing that among all the little component sectors. It's not till you get up in here where you start to see differentiation between sectors. People are now adding on to the winners and not rewarding the losers. So they're starting to search for winners. You see that every time you come out of the low ground up into a point where it starts to fray. Where does that rope start to fray? Around +1. So we're now starting to see the key leaders for this next market move, and now it's tech in the lead. So we'll remember that when we look at Dan's chart on Apple. Same idea, only now what we're isolating is just a simpler comparison between XLY, which is the discretionary, and XLP, which is S&P staples. And we see that for a long while in here, staples led the market up. And consumer discretionary was lagging until about here. And in this dark shaded blue region are periods when discretionary is leading the way. You combine that with the idea of XLK tech and consumer discretionary pulling the market north. So this is really a moment of growth on, risk on opportunities. So we'll keep that in mind. Thanks to Chi Weng Chong for that, preparing those slides. Here's a quick look at Charles Williamson's framing on Merck. We've been following that one a while. We saw how it was poised for weakness. He had his tactical short. On this breakdown, he added a second position. We might have been able to add that position here at the Z3 break or here at the collapsing dragon, but I also like the idea of waiting for having two R in hand before you add that second position short. Now, what I also like is his willingness to just say, this is supposed to fail large, and if it doesn't, we're getting out. So the argument of putting that second position on here is that we wouldn't have been surprised to see it collapse like it did right here. Right? We were hoping to see that move only on this time frame. It didn't. It started to do something else. So he doesn't sit here and try to make it work by staying in the position. He cuts his loss quickly. This micro loss is more than compensated by the major win here. So he's in great shape. Now what I want you to notice is that the very place that you put that second position on is a critical state. It's already out here by the Z3 lines. It's had 1, 2, 3 significant moves down on the 65-minute, excuse me. And it had collapsed out of this that move down, and right in here it was poised for big collapse. This big collapse here on that daily bar is this one. So we were just a couple days early, but that move of putting the second one on, when you realize that if that level collapsed, that's not support at all. It has a very good chance to run all the way down to here, which it almost did, to be honest. That's such a nice move, and I'm really impressed with you putting the second position on, and even more impressed of cutting that one quick. Now what I want to coach you towards is the idea that the place where it was in a critical state, that's still a critical state, because of all the price action that happened previously. That's this right here. That's a critical state now because this was a critical state. It could have taken that breakout and just failed back, but it didn't. It put in a really strong upward move. But we also see that it can collapse out of there. So this is a critical state for price. And so when this runs up as far as it can and then drops below here, that's sort of the trigger that tells you that's a tradable move too. Now, you got to get that intraday, you might have to be on 3-minute or 10-minute bars. But the point I want to make is that the critical state remains a critical state, and that's really a nice trade. Well done. And the important part is that we've now got a trade frame on this thing right here. Compound critical state. This thing could return to 106 easily. And if that collapses, you have to come all the way over to the daily chart and say if it collapses below 102, then the next support level is here. It goes to 100 pretty easily. So you can see that if you use this size box as a risk, you have 1-2 units of reward to the next identified support level at 100. And now you have to come all the way over to the weekly and say, here's that 100 target. And guess what? If that breaks, you've got to move to about 98. And if that breaks, that's not support at all. The next target is around 87. So this could be a big collapse, and you'd be well started in here. The main point is don't let this keep adopting this model here of, hey, this thing is, if it's going to fail, it's supposed to fail hard like it did here. And really like it did inside here. If it doesn't do that, then failure to fail is information. And so that a careful watch eye on your exit is really crucial to survival in what is becoming a little baby bull starting to wake up. You don't want to be on the wrong side of that. All right, we'll look at Dan's Apple trade here. So we've got weekly, daily, 30-minute. He's identified his measurements. If the R stat is $4.63, the R10 is 46 cents or 50 cents for rounding. And what we notice is that Apple, coming out of the turning point here in the PSAR flip from 130 on the SSC after the harsh winter, and the SSC has done nothing but 25% gain. And this feels like an amazing move that pulled back quite a bit, and it's like, what exactly is that? Is that the parabolic move at the end of a run? Or was that just the next stage of a rocket ship? How high could that go? So we can't, when we look over here on the daily, we're already past the last PSAR flip, by a fraction. So we are right on the border of leaving all of this behind and heading off into a brave new world. That makes this a compound critical state. So we're allowed to ask, what could it do? Well, we know on the downside, we can already see that the last time it was at that same critical state here, the big yellow box, it moved hard down to this yellow box, to the critical state. And now it's recovered. So now we're sitting at the top of this little trading range, wondering what's it going to do. Well, so now we're going to go back to the weekly to see if we can get some more insight. So here we are at the top of that range. This little peak right here. Here's that little triangle that we see right there. So the last move from this price level took it to here and also took it to here. So you're not allowed to be surprised if this thing gets to 176. So a breakout from here could go to 176. So an entry around 157 to 176, that's 19 bucks, so call it 20. A $20 move to the upside is baked into the cake. Now, you're also not allowed to be surprised if from this location this thing sells off to 128, because it already did. So that's what makes this thing so important. The fact that it's hovering right on the edge of a knife blade right there draws in all sorts of extra enthusiasm and energy and money, and whichever side wins, either the bulls or the bears, the winners are going to be flush with emotion and want to buy more. The losers are going to want to get out and bail out at any price, or vice versa if it goes the other direction. And so that's why you get exaggeratedly large moves. The fact that we've had a couple big steps up in Apple says, along with the market itself rotating into tech, if tech is genuinely the leader that we just saw, it just picked up the tech power right in here. Well, Apple is primed to be able to do more of that, because everybody that looks at this that's an optimist about Apple, it says the sell-off was an anomaly. They may have even been buying through here. At the first sign of continued strength towards 176, you'll see some more buying pressure. So the upside case is 20 bucks. The downside case is 157 to at least 141, but we could also see it getting to 130. So there's a 20 bucks on the downside either way. So if there's a $20 move from a tight risk box, even if you were just managing $4 or $5, which is the size of the range stat, that's a pretty wide sum, and you still have a 4-to-1 or 5-to-1, 4-to-1 move in either direction on a swing. So you don't even have to worry about, is that kind of move available? It really is. Now, if you can, if on a swing trade you were worried about overnight risk, you might use that $5. And so if you were going to invest 400 bucks, let's just make it 500. If you're going to put 500 bucks into the trade and you were risking 5 per share, you could own 100 shares of Apple and hold it overnight, knowing that you had a full range stat buffer to protect you against adverse gaps for losses greater than 1. If you were to adopt a turbo strategy where you wanted to get some intraday stuff, you might be able to use a $1.42 or even a frog box, call it $1, that same $500 of risk, where you're only risking $1 per share, could give you 500 shares. So let's imagine this thing takes off through here and you've got 500 shares with a $1 risk, and that thing is moving up. It gets to 160. You're plus 2 in hand. You just take your stop and move it above there. And so that day you're not going to lose any money, because you've locked in a no lose plus dinner for 2. And then if it starts closing well, you could make a decision. Do I want to hold this as a swing trade because it's there's no resistance overhead and it's working? You might. Your overnight risk, if you decided you wanted it to use a range stat to protect you, you would sell 400 shares and cash the $2 per share. That'd be 800 bucks in hand, which pays for the 500 bucks of risk. And then your overnight risk is a $5 per share on 100 bucks. So you're risking $500 on the overnight trade, but you've made 800 from the trade itself already free and clear. So that money you could think of as markets money and as funding the overnight risk, and you've taken your original risk capital off the table. The original risk was the dollar per share that you used of your seed capital to get this thing started. And then when it starts working quickly and you get to no lose plus dinner for two, now you've taken your risk out. And then if you hold it overnight, you're using the market money to fund the overnight risk. And then you still have that residual money. So tomorrow, if it starts working again, you just put the extra 400 shares back on, and now you've got an intraday position. So your core and turbo would be intraday. You're carrying 500, and then overnight you're carrying 100 because of the wider stop that you got to maintain to protect against a greater than 1 hour loss. So there's this. Let's now see where Dan has these triggered. He's looking to trigger long if it breaks above the RL10. So that would be the emerging dragon breakout. He could also, it may be, yeah, I think he's looking for a possible short at 154. So if this thing, which started to sell off, doesn't hold, what you want to see is this thing go right away. But if it doesn't, and if the market were weak, so in other words, if market and tech sector are down, take last week's PSAR flip short for a good risk reward. I think you could get short right here. And then if this broke that gap, you could add a second short here with a target to here. And if that broke, get a third position on it, you'd be pretty pleased with that. So I think he's got a nice plan here. Yeah, all these things here that you've got noted in terms of sentiment, that's all news. And if it's, I'm just going to ask you what the time and energy cost of doing that is. And it starts as simple as, how long did it take you to type that up for this chart? And how long did you have to think in order to put all that stuff together? The argument I'm going to make is that when you see a range compression like this, a volatility compression like at that big blue dot, you already know just from the technical features that a large move for any reason can happen. In this case, it happened to go up. So if I had more time and energy, I would put it into find those moments, and I don't care about news at all. Because everybody that wins the trade, let's say it keeps going up, everybody will come over and say, those were the three pieces of news that predicted the upward move. I knew I was right. And so now you start creating a connection between news and action that may or may not have a causal effect, right? So I just say there's a carrying cost to doing all of that work and analysis. You got to find what works for you. But in my view, I spend my time trying to identify where these critical states are and where could it go if it breaks this way? It could go to here. Now notice what happened at this price level. Last time it failed, after it rose, it failed. This time it rose that far, which is another one of these levels. It fell back, and now it held at that level. And then instead of failing, it went up to here. And then when that broke, you got that enormous move. So you got all of that move in 2 bars. In 1 hour, it moved from 151 to 157. $6 in 1 hour. You know how many conditions... You know how many conditions like that I want to find? All of them. I think you get paid by finding those locations and those moments and framing the trade in both directions. Much more contribution to your bottom line in terms of effort expended. The same amount of energy and effort, what's paying you? Where are you getting paid? These are explanations and reasons. This is action and results that come from the frame. I think that framing matters the most. The more I don't look at news, the better I do, the better I sleep too. Because otherwise you got to figure, hey, what's the relationship of the news to price action? That's what everybody wants to know, and nobody freaking knows that, except it's the sum of all the actions of every individual actor that's out there that's buying and selling Apple for any reason. And now, what does each one of those think the news means? So you could all agree that that's what the news says, but everything in parentheses here is, I mean, I don't know. What do each of these guys think about some or all of that news, and how much money do they have, and where are their trigger points for action? So that's just like a little beehive of furious activity, and you have to solve that equation in order to establish the relationship between any news and any price action. And then you got to keep checking that to see if your formula is still correct. I don't know how you win. You can't possibly win that. I mean, the price move you're talking about is the reaction to earnings. I don't know that that's a reaction to earnings. I just know it was a price. The reason why it did that, I don't even care. What triggers my attention is the fact that there are these moments when we have abnormal compression and periods when we have normal oscillating behavior, and that there are times when we have these abnormally large moves, compression, movement, compression. So now I'm right in this little box, which I can define as that big as you have done. Can I see those moves? I don't have to know anything about news to know that there is a not a ridiculous argument that this thing could move large in either direction. And if it moved large in either direction, I'm quite sure millions of people will go find the news that explains why it did that. Just as if it had gone the other way, millions of people would have found the other news that says, oh, see, of course it's going to go up. I just don't see that adding any value to the way we are trying to trade, or the way I'm trying to trade with trade frames, normal behaviors, ranges and excursions and extensions and volatility. Now, what I want you to do is, don't make a decision to act yet. Don't make a decision to act on the basis of listening to me talk. So I'm over here, I'm an empty pot with stones rattling around and noise is emerging, and you're over here as a listener. You gotta receive that and think about it. What's it mean? How does it do? What's the basis for making the action? Now, you might do that as an experiment after a period of reflection. So every time you're in a group of people and you're over here thinking about what all is being said, you will find all kinds of triggers for action, because we are social animals. And communication is persuasive. So make as a habit, go to your fortress of solitude in a zero state and think about it, and then decide on actions you want to take that are measured, for reasons. The action you want to take should be connected to an intention in order to act as an experiment to get more information. There's a reason to take that action upon reflection, which you want to do in the zero state. When we reinforce that behavior, that model of thinking, you have taken the locus of control from the social group, however that's constituted, and you've simply taken that as information, and you've brought the locus of control into your area of personal responsibility, your R space, your responsibility space, your reflection space. Because you are solely responsible for the actions and the results, you want to make sure that you've given this due diligence in your place of reflection. What's that place of reflection look like for you? How do you get into that zero state? Where do you get into? Is it a physical state? Is it a mental state? Is it an emotional state? So as you're going about your life in this normal channel of behavior and activities, and then I want to get into my little reflection space in my zero state, from any moment, how long does it take you to get into your personal zero state for decision? What's that time? What are the conditions that have to occur to let you go from wherever you're at? How many heartbeats does it take you to get into that zero state? You know, the Hagakure says 7 breaths. Within 7 breaths, the samurai is ready to commit. So this is not just the mental state we want to be in the tactical trade, but it's the state that we want to be in, mindfully aware for all the decisions that we're making, and being judicious about how much we want to gain from the social space and what we're trying to do in that personal space. And then I'm concerned about, to make decisions all the time. I want to know this, how do I get to here, and how far away do I ever drift from that space? If I looked at this as a times, on a time scale, and I look at like layers of consciousness, I'd sort of like to have my values always in place, always there, and maybe my zero state, my reflection space is always here, and I'm cruising along at this level of consciousness, and whenever I need to, I can drop into that easily. By stopping all the other stuff I'm doing, I fall naturally into the zero state to recharge, reflect, react, respond, review, recommit, reconnoiter, all of those little things that go on in this roundabout space, like our true story circle and those little tones. When we hit those tones, we're instantly in the mindset to do that we're supposed to do. You should be able to get to that state in 2 seconds. Your note says, a few seconds or a couple minutes. 2 seconds. And for me, it's scratching my palm. There. And hit a tone, done. And I try not to get too far from that and go revisit it periodically. Little timer on my watch. Hey, get up and take a few steps. Walk around a little bit. Pull on a stretchy band. Get physical and get mindful of your physical plant. And that helps me achieve those R states. So I didn't mean to go off on all this, but I just know that it's, once you commit to it's hard to keep that up. And then you start doing it maybe out of guilt and run through it, and then it becomes a ritual, but it doesn't add value maybe. I'm not saying don't do that. I'm just saying that this actually this is the list of reasons why other people think it could go large in either direction. I infer that from the fact that every other day along the way, all of those things were being talked about, and the net result at that time was that it was moving the price that far. That's what I care about, is where is it and how far can it go. And once it gets there and didn't fail further, that's the information I'm wondering about. Hey, if it doesn't fail, what else could it do? Well, I could put a tight wrist box on it and then ride it. And now that it's up here where it used to be, it could be large or large. So I like the Apple frame. You've beaten the crap out of that dead horse. All right, Clorox. Thank you for doing this one. So, again, we're looking at I just lock in 30-minute, daily, weekly, just to remember what I'm looking at here. And this was that extraordinary move we saw, the one-day move in Clorox. And it looks like this move here. Let's see, opened, I think ran all the way up, ran all the way down, closed here, did not fail further, and then climbed the trail of tears up the ladder to get most of the way back to the top. So it retraced almost 80% of the initial emotional burst. Both of those, the emotional burst and the commitment to longer-term buying, those are both very powerful arguments why the upside could continue from there. And again, if you take the bottom of that little wrist box, or where the R10 reversed, and say, look, I'd be willing to get short here, and then if it broke below here, I might even put a second position on at 149, especially if I'm using about $1 right here. If it broke through here, I could actually think about putting a second position on here with the 2R battle drill, and that's about 4R. And then if that fails, it's coming back at least to here and maybe to here. So there are 3 large groups of moves that it could make. Could it do all that in one day? Well, it has recently. Doesn't mean it will. Probably won't, but it could. Now, what would cause it to fail like that? Would it be news, or would it be the reaction to news? It's the reaction to the news that is the uncertainty. The news is just words and facts already. They report the news. The only thing the thing that actually communicates possibilities is the reaction to the news. And that's the news we're trying to get. The news we want is not what they said, but what people are going to do. Where do you get that information? Price action. Okay. So you've got to, if you want to be news driven, be driven by the news of price change and not the news of reporters. My opinion. I mean, I still read the news. I still listen to it, but I don't try to think my way through it. It's like background noise to me. It's like white noise. It's like, oh, they're talking about this? Of all the things that they could be talking about, of 10,000 companies, all with news, the ones that get the threshold to be talked about, or on Bloomberg, or whatever, ... So there's already something special about that it broke that barrier and got into the public space. Do you think any professional analysts and traders who are studying those companies are surprised by anything that these guys say? No. The professionals have already baked that into the cake and are moving on it and are waiting for the people who react to news to act so that these guys can take advantage of that. Everybody that is a professional about that already knows all that news. I mean, if you're a major bank and you've hired a finance major and they're paying him hundreds of thousands of dollars to be an analyst, he better know to follow Apple. He better know something about Apple, or in this case, Clorox. So yeah, I like Clorox just on the basis of that candle. It's in play. This is abnormal times. And you can see that the normal range was between 150 and 136. So it's already well out of the normal space. It broke through the Z3 on the weekly chart, which was around 155. 155 right there is the Z3 line on the weekly. I would rather, if I was your boss, I'd say I'd rather you spend the time detecting that fact than listing all that stuff. The fact that this was such an abnormal, this tells me how abnormal. This was so abnormal that a one-day violated a Z3 line on the weekly, and it was back at 144, which was the middle of the weekly. At 144, it was there yesterday. It moved from the absolute center of mass on the weekly chart. That is the most average price ever, 144. That price line is the great dividing line between all things sad and miserable and all things bright and beautiful, to borrow those book titles. And that move was so great that it went 3 sigma on the weekly in one day, in the first 30 minutes. So, yeah, this thing's in play, and the guys who won are the ones who initially burst it up and then are still willing to buy it and hold that over the weekend. So I wouldn't be surprised to see it keep going, and if it breaks above 157 and made a new high, off it goes. But by the same token, I wouldn't be surprised that other heads might look at this and say, yeah, but if it starts doing that, we know what to do. But if it breaks here and then breaks here, it comes back to here. So you're going to prep it in both directions. I wouldn't say consider the... Here's what bothers me about that phrase. Consider the turbo trade if strength continues. Because you could rehearse that right now and decide what you're actually going to do. Your trading plan is to think about doing a trading plan while you are watching actionable information happen. So you're waiting to see evidence of an abnormal strong move, and then you're going to consider. So if I were to spend an hour with you right now, say, what are the things you would consider in order to, what is the threshold? What else do you need to know in order to act on the long side? I'll tell you it comes down to exactly the price that you intend. Let's say that it opens right where it closed, which is right here, I think. And it opens right where it closed, and it does that. Would you get in? Would you get in? You tell me to stop when you tell me you're going to get in. Would you get in? 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 So you'd probably say, you might say, hey, if it broke, actually, for me, if it broke above the RL10 peak, I would also accept if it broke above the high of the day yesterday. 2 different locations where I'm going to get in. I don't need more information than that, because as soon as it gets above this level right here, you have new information that buyers are coming in and buying it and pushing it up at a price level that it didn't work over here. It stopped right here. There was nobody buying in here. And then it fell all the way to here until new buyers came in and they could only get it this high. And then it fell back. So as soon as I see it get above here, that tells me new buyers are coming in. And the long side is obvious. This thing could go. It's left behind the last, 6 or 8 months of price, and off it goes. So I'm not going to consider the turbo trade. I'm going to decide today. When do I go long? And consider, if CLF's strength continues, how are you going to measure CLX strength? You could make it specifically it exceeds a certain price level, or you could take some indicators that are derivative of price action, which smushes all that stuff up and says, well, when the indicators tell me the price, hey, price is the indicator. When price gets above a certain level, you buy it with a certain amount of risk. See, that's how much risk I'm willing to take. So that if I buy it here, an adverse move of that far tells me that that experiment is over. That's your minimum manageable risk box. That tells you the number of shares that you're going to buy and how much risk you're willing to take. So don't consider the turbo trade, frame it, and commit to action. If there was information that you could see on Monday that would get you long, write it down, make it a rule, and commit to the trade. I don't care what those are. But don't make a trading plan which says, in the heat of the moment, with some nebulous if strength continues, then I'm going to consider it. Now you've added cognitive complexity in the heat of the moment. That's like stepping into the batter's box against Nolan Ryan that says, if he throws me a fastball, I'm going to consider swinging at it. Too late. It's already in the catcher's mitt. You better be ready to swing at a fastball if he throws one, and have rehearsed that and how long you're going to stay in, and go through the 7 questions of framing so that you frame that thing in both directions and you visualize and rehearse all of those decisions before Monday so that you're ready to trade. You've done all your thinking. You're ready to execute when the market is open. Plan, prepare, execute. This is a plan, but it's not prepared. So if you were going to trade that on Monday, you had better get some prep work done, or you're not going to be ready to execute. When do you have to be ready to execute Clorox? From the opening bell. Because it could do this. Do you want to be in the trade that goes from 159 to 149 to 160? That was an 8% move. That happened in quick, fast, in a hurry. Do you want to be trying to think about what to do while that thing is unfolding? Not me. Google. $30 daily and weekly. Where would you find the 7 standard questions? Well, first of all, it's a flashcard in the creativity course. It's also in the campfire. It's in the Cornell note sheets that Chin Long that Phil Wu put together. It's also in the glossary, and I'm gonna send you the questions here too, because I'm not gonna be a jerk about this. So I'm going to go to my flashcards. I better be able to find this or I'm going to look like a moron. All right, so in the glossary, standard questions to ask on every single trade frame. What do you see? What could it do? Which way would you trade? Where would you enter? Where would it fail? Would you stop and reverse? And then on a winning trade where you've moved it to no lose plus dinner for 2 and taken your risk out, you answer, now, how far could it go before it starts to stall? When does it hit resistance? Where would I be triggered to begin preserving profit as opposed to being driven by hold on for longer in case of big gains? So whenever I make that, when I see it stalling and I start thinking about preserving profit, I then say, now, if it resolves upward in the direction it wants to go, where could it go next? So now I have to build the price ladder of resistance. Now, if it gets up to a certain level and it starts to fail, would I stop and reverse that winning trade or not? And if I would, how far could it fall back? And why is that a good trade? But then if it goes up and hits the 2-hour battle drill and I get out and it doesn't fail but it starts to resume, where would I re-enter? So these are the standard questions on every single trade. It makes you frame the trade in both directions, as it says, and then that will give you a properly prepared trade frame. Then you are ready to execute when the market opens. Now there's a better version of this somewhere. But that's what I want to say about that. I think that was the last one we wanted to look at Google. Yeah, I think Google's in the same condition as the other two. After extended sell-offs, they had big bursts up that show that they're in play. Now I like the Google frame here because this thing has rendered itself down into a minimum manageable risk box like that. To me, I'd be short right there and add a second position either there or here, thinking that if it fails here, it's going to go to this level. That's my target. And this is where I could add a second position here, because if that fails, down it goes. Hey, if it fails at 97, where could it go? Well, I come over here and find 97. That's if this fails. That's simply the PSAR flip, and if that fails, it goes to the far side of the river, to the other side of normal. That's a normal move. And this is where it's supposed to hold. That's why the statistics will find those areas of resistance and support, and that's why that becomes the edge of the river. So it's a normal move to fall that far. It's normal to find support there and reverse. Where? To the top of the river. Notice the top of the river, top of the river. That's all abnormal gains. So if this keeps going, how far could that go? Above 112. It could go to the top of the dragon. This thing could go to 120 easily, just on this basis on the weekly chart. How far could it move in one day? Well, it moved from 100 to 108 in one day. So it could go from 108 to 116 in a day. That's why I got to be prepared to trade from the moment the market opens. So download that glossary 4, frame the trades using the standard questions. And now I'm going to say, take a look. I think I gave you access to the bar by bar workshop as a consequence of taking Creativity 202. We do that in real time with those questions, and we frame those trades rapidly, and you'll see how fast we get it done. I don't care anything about news and all that other crap. I want to know where the prices are that trigger actions to make effective decisions, and are those reward to risk ratios proper in both directions, so that I'm not emotionally connected to one side of the trade or the other. Anytime you get a critical state that's a good one, it can go large and for any number of reasons. And here's why. If it's in a critical state for the day traders, that means that these guys have been day trading it back and forth, and that was an important price level for them to respect. and to act on right at the edge of that trading range. So that means if they bought it down here and that thing got up into here and started to fail, they're not surprised because that was a support level that held in the past. Hey, what if the guys who were looking at this over the last 30 days, that it turns out that this was also a 30-day high? And they get triggered when things are going to break out of their 30-day look-back trading range. So now suddenly all the guys that are swing trading this notice that there is a critical state happening, and all of that money is anchored into breaking out here. It didn't activate at the critical states the day traders had in here, but suddenly when it gets to this price level, now suddenly all of this money is interested and getting ready to act. And now suddenly when that thing breaks out, it makes a huge move because it's not just the day traders that are pushing it. It's all these guys that were on the 30-day and the 150-day high. That look. When you get multiple independent demographics all chipping in at the same time, every one of them gets surprised. I want you to think of it this way. There's these little cubicles with a computer screen on it, and there's some little guy in there with a bucket of money ready to trade that, and they can't see each other. They're doing what they do, and that little kid, that little monkey is in there trading away and trading away and trading away. And maybe the day trader over here and the swing trader and the position trader, those three categories. And the day traders are trading this thing all around and around in here, and it's not in a critical state for these guys. They're not close to their action points. So the only guy trading is the guy right here with his little bucket of money. And how many traders are there? And how many are on the long side and how many are on the short side? Half and half. And then there's some guys that can go both ways, if I can say it that way. And as a result of this interplay of this little group of day traders, this thing has normal daily intraday volatility. It monkeys around. But over time, that thing comes up to some price level that is at a critical state for these guys, so they're all ready to trade. But now it's near a 30-day high. It was never near a 30-day high all in here, but as soon as it gets near the 30-day high, now suddenly all of these guys are activated, and all of the money that's in here is ready to pile on to the breakout. And when that happens, these guys are not used to that money coming in, so they're going to be surprised. And then this guy's going to be surprised because he wasn't accounting for the behavior of day traders. So both of these guys, their actions are surprising each other. Hey, what if that critical state was also from these long-term position traders, like a 150-day high, and now suddenly all that money comes in? Now the same price that triggers Group 3 is triggering Group 2 and Group 1, and all those guys are mutually surprising, and you get this explosion of a move that none of them were expecting because they are always in their little cubicles working on their signal and trying to avoid the noise of those other areas because they're focusing only on their screen. So how do you find those moments of compound critical states? That's what the sniper report does. So let's just look at where we are. SPY, daily chart. Here's the 150-day high and the 150-day low. See those turning points when the RL10s reverse direction? That is never a trivial moment. So this is the 150-day box, that big one out here. We're only 10% or 20% away from breaking out from a 150-day high. Now, how many of those guys that are watching their long-term position trades are ready to add positions if it breaks to I don't know, some, a non-zero number, and that represents a lot of money. Those guys couldn't be bothered while it was all in this noise. That's noise to them. But now suddenly prices coming up in here. All of these guys from the 150 are now interested, and they're bringing all that money with them, ready to act. Now, how are they going to act? Some of them are ready to pile on this way. Some of them are saying, dude, the last time it was at this price level, it sold off in such a heartbeat, so I'm going to make sure that as it approaches that high, I'm going to have my stop in here. And maybe his stop translates to here. So maybe that thing goes up from here, starts to fail, and it hits this, and all of a sudden, all of these stop losses hit from guys that long-term were riding it all that way, or were riding it all this way, or were riding it all that way. How much money is in those different buckets ready to be triggered by this tiny little compound critical state? I don't know. But if all I ever look, if I'm just an intraday trader, a day trader, and all I'm looking at is 3-minute charts, and I don't have any interest in what's on the other side over this way, for long periods of time, the only people interested in it was the little day traders. But now suddenly it has a little compound critical state, which I'm not aware of because I'm not looking at that. And suddenly all the money that's over in here tries to fit through that little valve. It looks like a power hose. And the thing goes, it responds to that water pressure through that tight aperture, and up it goes. Or it all collapses. So the search for compound critical states causes you to spend time to look for places like right where we are right now. Look how far it moved in the 150-day look-back period between the highest high and the lowest low. It went from 430 to 350. $80. The 30-day high, which is here, and the 30-day low, which is there, in 30 days it went from 418 to 376. 24 and 18 is 42. So in 30 days, it moved 50% of the distance that it took 150 days. So that tells you that 30-day range was really volatile compared to the 150-day range. Look at the 10-day range. It went from 418 to 394. 6 and 18. So that was a $25 range. The 30-day range was a, what did we say, 40? 40? And the 150-day range was 80. That's a lot of activity on a 10-day basis. The 5-day range is almost as large as the 10-day. That's how volatile this thing has been, this rocket ship up. The market cannot sustain that kind of volatility. It goes through peaks and valleys, like a frog jumping, explosion, rest, jumping from lily pad to lily pad. Each little lily pad, or a stepping stone in a raging river, is a safe place where it recovers and figures out what it's going to do next. Now, when all of those time frames are pointing to price location that is near the upper extreme or the lower extreme of the look back, or exactly in the middle, those three trade locations, way overbought, way oversold, or absolutely neutral in the middle. And if I have a tight risk box here, and it's 1, 2, 3 to the upside and 1, 2, 3 to the downside, by being perfectly placed in the middle of the range, I can frame a critical state trade in either direction. So now if I got trade location, I also care about volatility over the 1 day and the 5 day, because that is evidence of abnormal range in the short term suggests that this thing is in play, ready to pop. So if this represents normal volatility, here's the average, and here's +1 and -1. So I'm interested in abnormal noisy and abnormal quiet. When it's very noisy, it's in play like it is right now. When it's abnormally quiet, that thing is compressed to such a tight little range that you get a big move in either direction. In this case, it was up. Here, look at how tightly compressed this all was in here. Big move up or big move down. So when you combine all those things and you notice where the turning points of the RL10 are, look what happened here. This thing went from here to here and came back to a decision point. What's it going to do? Well, the last time it was there, it went up. So we wouldn't be surprised if it went up to here. We also wouldn't be surprised that at this price level that it could go down. How far could it go down? Well, it went that far. So we're not allowed to be surprised out of this critical state here that it could make that move or that move. And if your risk box is small and you have 1, 2, 3, 1, 2, 3, how much more do you need to know? None. You don't need to know any news. You just need to remember that the news generates reactions to news. Reactions to the news are expressed usually through emotions, up or down, and those lead to actions to send price moving. Do you want to know how people are going to react ahead of time? Well, just read the future. And then come back. Go to the future, come back and tell us. Or just follow the price. The price calibrates their reactions. So you know what the difference between normal and abnormal is. So our job is to find these critical states. Look at this one. Holy mackerel. From this common price level for the last 150 days, look at what it did. It went here, 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 here. It also went here, here. So you're not allowed to be surprised when there's a big move from out of there. Now let's see where we are right now. That's pretty close. From that price level, what has it done? It did this. And it did that and that. Now, are you allowed to be surprised if this thing comes at least back to the last way station? That's like a train station, the last previous critical state. Are you allowed to be surprised if this moves like that next week? No, you're not allowed to be surprised. Because it's done that 2 out of the last 3 times. You can't be surprised if it does that. Would you be surprised if it did that? It's harder to believe in, if I'm being honest. Which is why it might actually work. Because at least one time, here, it did that and got to the 150-day high. So that makes this a perfect critical state. Now, who's leading in the market right now? We already saw that. XLK, XLY. Tech and consumer discretionary. What is suffering? Energy, finance, materials. Now I can start constructing some scenarios and say, look, if the S&P starts going down and if energy, finance, and materials are worse, that's where I want to be short. Easy. If the S&P is going up and tech or XLY are going up, I want to be long and in those right now. And if I'm in XLK, I could say Apple might be doing better than XLK, and that's my argument for Apple. So I don't. If you saw evidence of strength, how much more do you have to consider about getting long Apple? Zero. What the only thing you have to decide is specifically the trigger, and you just say, look, this thing is in a little box. This little rabid wild animal of Apple is in this black box, and if I open the cage and that little hungry wild animal goes north, are you surprised? No. If he comes out of the cage and runs that way, are you surprised? No. So all I got to do is put a tripwire and say, look, if he crosses that line, I'm in and I'm long. And if he crosses that line, I have evidence that he's going that way and I'm short. So now what do you know? You know the size of your wrist box. Is that a manageable wrist box? You tell me. Would you take more than, if you got long here and then it reversed, could you get out with not worse than a 1R loss? You better, because you're going to make that 1R and you're going to stop and reverse and go here, because he might have come out of the gate and gone this way and then done that. Not surprising. All I know is if he's below that red line, I want to be short, because he's going to come this far and there's 1, 2, 3 that way. So I've done all the considering. I am deciding and committing and prioritizing. Check or hold? Yeah. All right. That's everything I want to say for tonight.